Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Asian stocks advancing after Wall Street snaps a two-day losing streak, with U.S. CPI boosting bets of a Fed rate cut next week. Israel carries out more military operations in Syria despite facing intensifying criticism from governments in the region. This as U.S. envoy Antony Blinken returns to the Middle East for a 12th time. Plus, Donald Trump reportedly reaches out to Xi Jinping even as he threatens tariffs, inviting China's leader to his inauguration next month. Well, it's just gone 7 a.m. in Saudi Arabia, 8 a.m. across the Emirates. I'm Christine Burke, in today for Jumana Bursecci. Well, let's take a look at the action that's going on in markets. In the wake of that CPI print yesterday, we do see that inflation is proving to be somewhat sticky, but the fact that we did not see an increase in inflation out of yesterday's data has led markets to pretty much cement the expectations that we'll get a Fed rate cut of 25 basis points next week. But if you look at U.S. futures this morning, we are moving lower just a touch after we saw a record level hit for the NASDAQ. Also looking at the Bloomberg U.S. dollar index, a touch of weakness there. And just remember that today we do get U.S. producer price inflation out of the U.S. So that is the final inflation reading the Fed will get before next week. Another place to keep your attention on today will be the euro, because we get an ECB rate decision a little bit later. And the expectation is widely that we will see a fourth straight consecutive rate cut of 25 basis points. So that is your markets check there. And looking at this chart here, going back to the Fed for a minute, you can really see here that the markets, or how much the markets have ramped up that bet for a rate hike next week, almost fully priced in now. But when we look to January, barely anything priced in, suggesting that we are going to get a little bit of a pause. Well, outgoing Treasury Secretary Janet Yellen says tariffs on China will hurt the U.S. economy and provoke retaliation from Beijing. She spoke to us exclusively in Washington.
Broad-based tariffs, almost all economists agree that what they will do is hurt us by raising prices, possibly substantially, and making it more expensive for firms that need inputs from China to be able to acquire them, and harm our competitiveness.
Despite his threat of stiffer tariffs, Trump has reportedly reached out to Xi Jinping, inviting the Chinese leader to his inauguration next year. Let's bring in our senior editor, Bill Ferries, who's standing by in Singapore. So, Bill, thanks for joining us. This is kind of an unprecedented request for Trump to be making this, isn't it?
Oh, it definitely is. And it may be some kind of an olive branch or a nice thing to do, but I would never say there's a 0% chance of something happening with Donald Trump, but there is a very close to 0% chance of this happening. It would raise a lot of political risk for Xi Jinping if it happened. He would be sitting in the audience on a cold January day in Washington, listening to Donald Trump potentially go off script in a speech in front of him, and Xi Jinping would have no way to respond. We're looking into State Department records. I mean, foreign leaders do not typically go to U.S. inaugurations. We think it's been at least 150 years since a foreign leader has attended a presidential inauguration. So I would be very surprised if Xi Jinping somehow accepts this and attends, though I do imagine that the Chinese Foreign Ministry is probably looking at a diplomatic way to respond. It's certainly a nice offer, but I don't think it's one that either side really expect the Chinese government to accept.
So then what's the point of making the offer in the first place, especially when the rhetoric from Donald Trump has been really hawkish against China?
It is as a potential olive branch. These are the world's two biggest economies. They have to find a way to work together in a lot of ways. But Donald Trump has come out very hard so far in the campaign and this transition, saying he's going to impose a pretty wide range of tariffs. This just may be a way of saying, hey, I think we can talk about things. Let's find a way to work together. If you go back to Joe Biden's administration in 2021, there was a lot of concern about how that relationship would work out. They agreed to have their top diplomats meet in, I think, March 2021 in Alaska. That was a rough meeting, but it did at least get talks rolling again. I think that's probably more the type of signal that Donald Trump is trying to send here.
All right, Bill. Well, as we get a bit closer to Donald Trump taking control of the White House, I suppose we'll see what happens next. That was Bill Ferries, our senior editor in Singapore. Well, back to the Middle East here now. Israel has continued attacks inside Syria despite facing intensifying criticism from governments in the region. The military says it were targeting what it describes as threats and terrorist sites along the border with Syria. U.S. Secretary of State Antony Blinken is on his way back to the Middle East as the Biden administration tries to shape the unfolding chaos in Syria before Trump's return. Bloomberg's executive editor for the Middle East, North Africa, and Russia, Stuart Livingston-Wallace, joins us now. Stuart, good to see you. So we see that Israel continues to advance its actions in Syria over the last couple of days. Israel has said that this is an offensive to prevent weapons from falling into the hands of terrorist organizations. What do you think the IDF is really trying to achieve?
I mean, I think that's exactly what it is trying to achieve. I mean, the aims are perfectly clear, that it's taken a look at history, so places like Yemen and Libya and Iraq and Somalia and countless other examples, that when the central government collapses in a heavily armed state and militias take over, then that poses a real threat to the neighborhood. So they're taking a look at Syria, which was indeed a heavily armed state and whose leadership was using chemical weapons as recently as 2018, possibly even later. We know it's got chemical and biological caches around the place. We know it's got heavy equipment everywhere. And we also know that Syria is now basically a patchwork of militant groups with no centralized control, and each of them with its own somewhat unclear aims. And therefore, as a neighbor of that, Israel is taking the view that better to preemptively strike as many of these arms caches as it can while the going is good, so that this does not pose a threat for Israel in 6 months, 6 years, or whatever the case may be. So the latest estimate is that they've probably taken out 70 to 80% of what they think is out there. But again, it's a bit of a moving target, and you should expect more of this in the days going forward.
Yeah, and I suppose the question also becomes how HTS under Mohammed al-Bashir and Mohammed al-Jelani possibly respond to this if they do. Also something on the radar this morning, Antony Blinken is on his way back to the region. He was set to depart Washington yesterday. What is he expected to achieve on his trip here, and what is the role that the U.S. is looking to play in Syria?
I mean, at the moment, the US is not playing a particularly big role, and that's largely because it's a fairly chaotic situation on the ground. It all happened rather rapidly. And actually, the main players are changing, again, rather rapidly. So, you know, obviously, Iran and Russia were two of the main players in Syria up until probably about a week ago. Turkey has been and continues to be a major player, and now you're seeing Qatar coming back into its sort of traditional mediator role on behalf of the Arab states and making diplomatic overtures. So Blinken is coming in, I think, to try and establish some sort of rapport there and to figure out what's going on, because the international community, at least at the moment, is taking sort of a rather guarded view of what might happen going forward. You remember, again, many of the groups now in charge of Syria have somewhat problematic past in terms of being designated as terrorist groups by the US, the UN, and others. And despite the sort of the attempt at rebranding we've seen over the last several weeks, it remains to be seen what actually transpires on the ground as they consolidate their control. Blinken is there basically to figure out what is going on and what role can the US play to make sure that it is a smooth transition into something resembling a civil state.
Right, and also in Israel at the moment, but not on the Syria side, on the other side of the country with Lebanon, the Israeli army has ceded control to the Lebanese army in a key southern Lebanon city. This seems to be the first major significant city that the IDF forces have given back to Lebanon, or back to Lebanese control. What's the significance of this? What does it say about the ceasefire that was struck a few weeks ago?
I mean, I think it means that it's on track. So there have been some wobbles along the way, and I think that was to be expected. There have been some exchanges of fire every few days for perceived violations by either side. But it's also clear from the rhetoric coming out from both Jerusalem, Tel Aviv, and from Beirut that the intention there is to keep going for the 60-day pause. There are days where it doesn't look like much of a pause. And ultimately, the IDF would like to get out of southern Lebanon. Remember, it's a very costly operation for the IDF. It's fighting in multiple theatres. I don't think it has any intention of staying there any longer than it needs to.
All right, Stuart, thanks for sharing your insights with us this morning. That was Stuart Livingstone-Wallace, Bloomberg's executive editor for Middle East, North Africa, and Russia. Well, Bloomberg has learned that Russian President Vladimir Putin is demanding to know why his intelligence service wasn't able to spot the growing threat to Bashar al Assad's rule until it was too late. Assad fled to Moscow as opposition forces advanced towards Damascus. Sources say Russian intelligence agents organized the escape, flying Assad out of a base in Syria before the aircraft's transponder was turned off to avoid being tracked. For more details on this story, Bloomberg's Henry Meyer joins us now. So, Henry, some really nice reporting from you overnight on this. What do we know about what happened between Putin and Assad and the lead up to his escape from Syria?
Yeah, good morning, Christine. What we know, of course, is that Russia was taken aback as much as anyone else by the very swift and dramatic events in Syria. And as the rebels were progressing, we know they began this offensive on November 28th and swept out of the northwestern city of Idlib, where they had a stronghold, and very quickly captured Aleppo. When they took the city of Hama, which a few days later, that was when really the alarm bells began to ring in Moscow, and they realized that things were slipping out of control. And if you recall, the city of Homs was the key strategic city that basically control of that city cut the country in half and would make it impossible for Assad to remain in power. And the last 2 days, those were the critical days. So the Friday and Saturday, on Sunday, as we recall, Damascus fell. The rebels entered the city and took control. That was when these talks took place between certainly, we don't know who exactly was on the Russian side. It may have been Putin, or it may have been someone senior who spoke to Assad and basically gave him the message that he had to give up. There was no way he was going to be able to hang on to power, and he needed to get out of the country as quickly as possible.
Right. And Henry, based on your reporting, what kind of conversations do you believe are happening on the ground in Russia now? This fall of the Assad regime carries such significance for Russia. It has 2 military bases to protect in the country. What does this all mean for Russia's military presence in the region?
It's very worrying for Russia. These are very key bases that they have. The naval base is Russia's only naval facility in the Mediterranean, and the air base that it has, called Khimim, it relies on to supply its operations in Africa, where it has a number of countries. Russia has security arrangements with those countries, which is a very key projection of Russia's global footprint. What we know on the ground is that the rebel forces are in the vicinity of these 2 bases, and while they haven't actually entered either of them, there's great nervousness. Already a certain number of warships have left Tartus, the naval facility, and there's reports that a lot of equipment has already been transferred out of the airbase. So it's not 100% clear what will be the future of those 2 bases, but if Russia does indeed lose them, it would be a major setback for it.
All right, Henry, thanks so much for that. And I just want to note that a bit later in the show, we will be talking about how important those Russian bases are to Africa. So stick around for that. Now, for some of the other stories that we're following this morning, the U.S. is warning that Russia may fire another intermediate-range ballistic missile at Ukraine, similar to the one it used in an attack last month. This as the Russian Defense Ministry promised to respond to Ukraine hitting a military airfield with what it says were U.S.-supplied missiles. Both sides have recently ratcheted up missile attacks in the nearly 3-year war. FBI Director Christopher Wray says he will resign before Trump takes office, prematurely ending his tumultuous tenure as head of the nation's top investigative law enforcement agency. The president-elect has made it clear he would not keep Wray on at the FBI when he takes office on January 20th. Now, Wray has told staff that stepping down is the best way to avoid dragging the bureau deeper into the fray. And still ahead, we speak with the CEO of Egypt's leading real estate developers, Palm Hills. Yasseen Mansour is joining us later this hour. This is Bloomberg.
And our budget proposes an additional $3 trillion of deficit reduction over 10 years. And I think that's necessary to make sure that our fiscal path is sustainable. Now, Congress hasn't really done anything to, beyond what I've mentioned, to improve the fiscal outlook, and I think that's a shame.
Treasury Secretary Janet Yellen on the fiscal outlook on the U.S. Well, the benign U.S. CPI data that we got yesterday has pretty much sealed the deal for a Fed cut this month. That's at least according to investors and market expectations. Asian shares are tracking their U.S. peers higher this morning, and we also get an ECB rate decision later today. Let's bring in Rashmi Garg, Senior Portfolio Manager at Dhabi Capital, who will help talk us through all of these developments. So, Rashmi, it's great to have you on with us. Let's start with the U.S. CPI print. That figure came in yesterday indicating that inflation is proving to be a little bit stubborn. We're not seeing any increase, so it's really maybe not that much of a problem for the Fed. Market expectations are definitely that we're going to see that rate cut next week. But looking into 2025 and inflation, do you think the Fed is facing a situation where inflation is higher for longer?
Hi, good morning, Christine. So yes, 2025 right now is a bit uncertain. And the main reason for that is while we've seen inflation being a bit sticky, but if you look at the underlying components of inflation, the OER becoming a bit lower definitely was good news. For 2025, the main risk is centered around tariffs and Trump's policies and the immigration policies that he intends to implement. Now, these things in practice would be inflationary in nature, and which is where, if we see any uplift to inflation as a result of these policies, then we might see a bit of a slower path of rate cuts or a bit of cautiousness from the Fed.
Yeah, and the markets are pricing in more than 80 basis points of rate cuts next year. Are you in the camp that that's still possible, considering Trump 2.0 policies that carry implications for inflation, for the economy, trade deficits?
Yeah, so right now, what we believe is that we are likely to see 2 rate cuts in 2025. And the reason is that we are also, what we think about Trump as a person, he's a businessman and, he's a negotiator as well. So his bark can be worse than his bite. And some of the things that he says might actually look a bit different in practice. Plus, we also have to see what happens with Doge. There is a lot of spending that they've promised they can, bring out of the system. And Elon Musk and Vivek Ramaswamy, these are 2 very successful businessmen. So we want to see how the balance of things falls in 2025 with all these things that are moving factors right now.
Right, and let's go back to monetary policy because we get a rate decision today from the ECB. The market expectation is that we will see 25 basis points of a reduction today. But when we look out to 2025, things are a bit more uncertain, if you will. We have expectations that there may need to be a quick succession of rate cuts. How far and how fast do you think the ECB needs to move in order to combat some of the weakness that we're seeing across Europe?
Yeah, so I think ECB definitely is in a very different scenario when it compares to the Fed. We are seeing a lot of weakness in Europe. And of course, if the threat of tariffs comes true from Trump, then that is going to further add to the weakness, the economic weakness that we are seeing out of Europe. So ECB, we may need to move faster. And we might sometime in 2025, once, Trump takes office and, takes oath. And if really he actually actions his threat of tariffs, then we might need to see a jumbo rate cut from ECB as well.
And what are you making of the political turmoil that's happening in Europe at the moment? France in particular, there's also a struggle happening in Germany too. Is that something that's front of mind for you?
Yeah, I mean, see, as equity investors, definitely we do not like uncertainty, and the political turmoil really adds to the uncertainty, apart from, what we are seeing in terms of the economy and the labor markets as well. So clearly, I mean, this is something that puts that makes Europe even less attractive for us. I mean, France, clearly the snap election after that, the budget getting rejected and, Prime Minister Barnier being, resigning, that clearly is not a very clear picture. And in February, we are likely to see, elections in Germany as well. So clearly, I mean, that does not make Europe attractive from an investment perspective, from a top-down perspective for us.
And I want to jump to Asia just quickly before we wrap up, because we had a report out yesterday around Japan, a Bloomberg exclusive, saying that the Bank of Japan wouldn't be against the idea of moving on interest rates sooner rather than later. Does that put a BOJ move next week in play for you?
We are of the view that BOJ is more likely to cut in January, the 25th, more likely to hike in January. And that is mainly because we feel that, given that, the BOJ meeting is really, a few days after Trump's coming into office, the backdrop would be clearer to them. And given that, Fed is already on the path to rate cuts, and then we are expecting a rate hike. The rate differential, which really is the main determining factor, is also, it's kind of narrowing down. So I think that does give some room for the BOJ to really hike rates in January. Having said that, we do believe that all the conditions of a rate hike from the BOJ are being met. Inflation is steady, and we are also seeing some steady growth in the economy in Japan.
Right, and it does seem that a move next week is a little bit up for debate. We had a Bloomberg survey out earlier today showing that most traders believe that a rate hike is more likely for January, but about 40% of respondents said we could see action next week. So thanks for all your insights. That's Rashmi Garg, Senior Portfolio Manager at Dhabi Capital. Some great insights there. Well, still ahead, Saudi Arabia scores the right to host the 2034 FIFA World Cup. We'll discuss the kingdom's plans later this hour. This is Bloomberg. Welcome back to Horizons, Middle East and Africa. I'm Christine Berg in Riyadh. Brazilian President Lula is to go through another medical procedure today following brain surgery earlier this week. The president's doctor told reporters that the procedure is low risk and intended to prevent future bleeding. He says the 79-year-old president's health situation has not worsened. This is Bloomberg. Good morning. This is Horizons, Middle East and Africa. Our top stories this morning. Asian stocks advancing after Wall Street snaps a two-day losing streak, with U.S. CPI boosting bets of a Fed rate cut next week. Israel carries out more military operations in Syria despite facing intensifying criticism from governments in the region. This comes as U.S. envoy Antony Blinken returns to the Middle East for a 12th time. Plus, FIFA confirms Saudi Arabia will host the 2034 Men's Football World Cup. Riyadh was the only bidder after Australia dropped out. Well, it's just gone 7:30 a.m. in Saudi Arabia, 8:30 a.m. across the Emirates. I'm Christine Berg in Riyadh, in for Jumana Bursachi. Well, if we look at how markets are doing this morning in the wake of that CPI report, we are seeing a touch of weakness for U.S. equity futures. But remember that in the wake of that report yesterday, we saw the NASDAQ powered higher, so much so that we saw a record gain for the benchmark. This morning, as I mentioned, though, we are seeing a bit of weakness. You can see that there. We do get U.S. producer price inflation later today. That's the final print of inflation that the Fed will get before next week's meeting. So that'll be the thing to watch out of the States today. The U.S. dollar also pushing lower after gaining for the past 3 sessions. And then the euro dollar is another place to put some attention today. That is because we see Christine Lagarde take a rate decision a bit later. The expectation in the market is that we will see another rate cut of 25 basis points. A lot of it is going to be down to the kind of language that she uses, though, and what the expectation or the tone is really for what may come in 2025. And speaking of 2025, let's go back to the Fed for a minute, because while the U.S. CPI report yesterday basically cemented market expectations that we will see a 25 basis point rate cut next week, and you can see that coming through here in this chart with that purple line indicating that we're almost 100% fully pricing in a 25 basis points. But when you look out to December, you can see only 5 basis points hiked in for January, suggesting that we're actually going to be seeing a Fed pause in the new year. Well, let's check in on how markets in Asia are faring now. Avril Hong is standing by in our Singapore studio. Avril, it's good to see you. What are you watching over there?
Great to see you, Christine. Yeah, I mean, it's really about next week, right? And how the markets are almost fully pricing in that Fed rate cut. So Asia stocks are rising. The region's benchmark sitting at the highest level in about a month. Tech is leading the way. Major indices across the region, mostly in the green. And this is a day where you're also seeing Chinese indices enjoying a bit of a bounce as we wait for the readout of a 2-day economic work conference. Investors hoping for more concrete details on stimulus there. But in the meantime, in the morning session, we did see Chinese retail stocks surging after reports that some of these major cities, including Beijing, are considering a fresh round of vouchers, which would help to boost consumption ahead of the holidays. Now, it's not just the stocks that we're watching in China, also the currency, because just a day ago, we did see these reports that fuel speculation that Chinese authorities would have greater tolerance for a weak yuan next year, and that's received some pushback from the PBOC today, so a bit of firming on the renminbi as well. Christine?
All right, Avril, thanks so much for that. That's Avril Hong in our Singapore studio. Well, our next guest is one of Egypt's leading real estate developers and also an investor in education, hospitality, sports, and logistics. His company is now setting its sights on Saudi Arabia. Yasseen Mansour, chairman and group CEO of Palm Hills Developments, joins us now from Cairo. Yasseen, great to have you here with us today, and great to be speaking to you from Riyadh, as this is a place where you are focusing a lot of attention at the moment. What kind of investments are you undertaking here in the kingdom?
Hi, Christine. How are you? I'm doing different things. One is on real estate. First of all, we signed a JV with Dalla Group. It's a very big Saudi group that we're going to do a lot of things with. One is on the education front. We're planning to open up to 15 schools in Riyadh, Jeddah, and other cities within Saudi Arabia. We are also looking at investments in developments on both Riyadh and Jeddah. For the time being, we hope that we will be finalizing one of these investments within the coming, hopefully, first quarter of 2025.
Great. Well, I hope. Wonderful. I hope when you finalize that, you bring that news to us first. Let's talk about housing. You mentioned education, but also housing here is in shortage. There's estimates that the kingdom will need to build more than 100,000 homes a year in order to meet some of its home ownership targets by 2030. Are you targeting the housing market? And if so, what segments of that market are you specifically looking at?
I'm looking at mainly higher A and B market. That's our target. We're looking, as I said, at residential developments in Riyadh and Jeddah, and also office and retail investments.
Right. So can you put a figure on that for us? As we talk about education, we talk about housing, how much are you allocating to investment in Saudi Arabia in 2025?
In 2025, as I mentioned, we're looking at around $300 million as investments with our local partners on education. I think we're looking at probably another similar investment in the real estate in both residential and commercial development. So similar, around another $300 million.
Right. Okay. So 600 million there potentially. So not a small investment. And now, can you tell us what kind of revenue you may be targeting from your operations in Saudi as you work to expand here?
I think Saudi is a huge opportunity for all investors from the area and from Europe and US and Asia. I think the Middle East in general, and specifically Saudi, was always a supplier of funding for investments on the other side, both in Europe and Asia, of course, and in the US. But I think things have changed. And I think there is huge opportunity in the Middle East and in general, and specifically in Saudi Arabia. I think it's a land of opportunity for the coming period. I can see there is a huge shift in policies, pro-private sector, pro-investments. The caliber of government people that we've met recently, I mean, over the last 2 years, the quality is amazing. Most of the government employees come from private sector with huge experience, very pro-investments. Everywhere we go, we find there isn't much red tape. Actually, there is no red tape at all. It is becoming a land of opportunity, and I think that everybody should be looking at Saudi over the coming, definitely 10 years to invest in Saudi Arabia.
It's really interesting to me that you say that there's no red tape. We know that the government has been working to eliminate the red tape, so I'm glad that that's at least working out well in your view. Thank you so much, Yasseen Mansour. That's the chairman and group CEO of Palm Hills Developments.
Pleasure. Thank you. Thank you.
Well, Investcorp Chairman Mohammed Alaradhi still sees plenty of good investment opportunities in Europe, despite the recent turmoil in France and German economic concerns. The chairman of the Bahrain-based asset manager spoke to Jumana Bersachi at Abu Dhabi Finance Week.
Europe, obviously, there isn't much growth in Europe. There are challenges in the politics. There is geopolitics there because of the war. But we still continue to find good opportunities in Europe. Remember that the majority of pension funds and sovereign funds in Europe are actually mandated to invest in Europe. So, plus it's a huge market. I mean, the people that live in Europe is more than the United States. So, we think Europe is still a place to invest and find opportunities.
When we look at the outlook, many people are saying because inflation is proving to be a bit stickier, invariably what we're going to end up with higher interest rates, perhaps for a longer period of time. When you construct your portfolio, how do you think about the ramifications of living in a higher interest rate world for a longer period of time in the years to come?
So, you do multiple things. You obviously try and not pay too much. You try to position for add-ons that actually makes the price looks better. But we focus really on industries that we know that there is growth and that we can bring our experience and processes and triangulate across the markets to make the right returns for our investors.
What about the Middle East? There's a new partnership that you've announced with China, and I'm curious to see the progress on that fund. But then also just in terms of deployment of capital, how you see the evolution of the landscape over here.
So I think the Gulf is really doing very well, as you know. I mean, it's the strategic location between China, Europe, Africa. It's all the infrastructure that is here, it's all the good free zones, the smart cities, but also, the people, the young people, the dynamism that's here, the tech savvy. So the fundamentals of the Gulf is really very strong and continue to be strong. Add to that, dynamic, progressive leadership is really great. So we as you know, we have launched this fund with CIC, the Golden Horizon Fund, to invest in the Gulf and in China. And we will be focusing on consumers, technology, logistics, and the pre-IPO fund, which will be part of all this, has already started deploying money in the Gulf.
Welcome back to Horizons, Middle East and Africa. I'm Christine Berg in Riyadh. Well, the swift collapse of Bashar al Assad's regime in Syria is threatening a key Russian airbase that Moscow has depended on to project influence throughout Africa. Russia has also relied on a Navy base in Syria for access to the Mediterranean. For more, let's bring in Bloomberg's Ondiro Oganga in Kigali. So, Ondiro, it's really nice to see you. Thanks for coming on to talk about this story. How significant have these bases been in helping Russia build influence in Africa?
Hi, Christine. So this base has acted as a bridge that enabled Russia build influence across Africa in countries like Central African Republic and also a place like Sudan. What was happening is that they were using these bases, and these bases were accepting Russian fuel, Russian supply via ship. And in turn, they were able to build political, military and economic influence on the African continent at such a cheap price. What happened was they saw an opportunity and they pounced on it. In the last 5 years, there have been several military coups on the African continent. And when military governments come into power, there's sort of a separation between them and Western countries, and we've seen military on the ground exit these countries. For example, France, US, and British have exited the Western Sahel. And this has posed an opportunity for Russia to come in and fight alongside these military governments. What is happening now threatens that very ecosystem that has enabled this Russian network of mercenaries to operate in Africa. And so they'll need to overhaul the whole system moving forward. If you go back to 2018, they were there in the Central African Republic helping the government fight rebels. They've also been in Libya, and most recently, they're now in Sudan.
Yeah, and I'm just looking at the story now, and there are a number of countries that seem to be benefiting from these air bases: Libya, Sudan, Niger, Burkina Faso, Mali. Where do these countries stand if Russia potentially exits, and where does this new development leave Russia on the African continent?
Most of these countries have said they're going to continue their cooperation with Russia. They're hoping that Russia can find alternative routes to ensure that their supplies continue getting to the African continent. Libya could be one of those alternative routes. Russia has 4 bases there. The problem is that it's too far from Russia, and also there are airspace restrictions in Europe that will sort of hamper Russia being able to transport their supplies to the African continent via Libya. The other alternative will be Turkey. They've previously allowed supplies to fly through the airspace heading to Libya. But then again, Turkey and Russia have conflicting interests on the African continent. And so 100% partnership is not likely to be possible. But there's also something to be said about Russia. They're not doing a charity case on the African continent. They are also gaining from being here. They've been paid money to fight alongside these forces. And there are also resources that they have their eye on. Niger has uranium. Burkina Faso and Mali have gold. Central African Republic has gold and diamond. And Sudan has oil. So they have everything to benefit by being here. Chances are they're likely to take a step back, regroup, and see how they'll continue their operations in Africa.
Yeah, and it's really interesting. This just underscores how far-reaching the implications of the fallout from the Syrian regime are, with tentacles spreading all over and to Africa. So thanks for breaking that down for us. That was Bloomberg's Ondiro Oganga. Thank you. Now, for a look at some of the other stories that we are following this morning, Ethiopia and Somalia have agreed to lower tensions following talks brokered by Turkish President Erdogan. The deal allows Addis Ababa to build a military base on the coast of the breakaway region of Somaliland in exchange for a stake in Ethiopia's national airline. South Africa's inflation rate crept up by less than expected in November amid benign food price growth. CPI rose 2.9% in November from a year earlier, slower than the 3.1% in Bloomberg's survey of economists. Forward rate agreements now see South Africa's central bank lowering its benchmark rate by a further 75 basis points over the next 12 months. And Ghana's economic growth accelerated in the third quarter to the fastest in almost 5 years. That's after solid gains in the industrial sector. GDP grew 7.2% from a year earlier, and that was the quickest pace of annual expansion since before the pandemic. It was also well ahead of estimates. And coming up, Saudi Arabia shoots and it scores. The kingdom was officially announced as the host for the 2034 FIFA World Cup. We'll discuss those details next. This is Bloomberg. Welcome back to Horizons, Middle East and Africa. I'm Christine Berg in Riyadh. Well, Saudi Arabia will host the 2034 World Cup, marking the return of the world's biggest sporting spectacle to the Gulf region for only the second time in barely a decade. The decision is being seen as a major victory for Crown Prince Mohammed bin Salman's push to improve the country's image and to also attract tourists. But the bid has also been controversial from the start amid criticisms over the kingdom's human rights record. Joining us now is Anita Mendiratta, Special Advisor to the Secretary General at United Nations Tourism. Anita also works in an advisory capacity to the CEO at Saudi Tourism Authority. Well, good morning, Anita. I know it's so early where you are, so thanks for waking up and joining us. We've already spoken a number of times this week about this, and this is indeed a pivotal moment, a big moment for Saudi Crown Prince Mohammed bin Salman and his drive to diversify the economy. Part of that drive includes drawing in more tourists to the country. How much do you see the World Cup as being a play for more tourists?
It's absolutely a play for tourists. And I think importantly, and very much thank you, Christine, for having me on for this important conversation. This is a big win for the Saudi people, and it's a big win for the region. We've seen that with the Qatar World Cup and the impact it's had on the region as a whole. And fundamentally, if we look at the structure of World Cups, it's 4 weeks of football, soccer, and it works across the entire country. It's not city specific. So during the downtimes, during the times of games of play, this is the opportunity for the world to discover not just Saudi, but Saudis, and to really get an understanding of what the kingdom is as a people and a place. So this is fundamentally important for the kingdom as part of, exactly as you say, the complete transformation that the kingdom is going through, all framed within 2030, but going beyond that clearly to 2034.
Yeah, and it does need to be said that Qatar did see a huge increase in tourism arrivals in the wake of the World Cup. They were up 58% year over year in 2023, which was the year after the World Cup that was hosted there. As we consider the need for tourists that potentially do come to move around the country with the World Cup being held across 15 different cities, that kind of connectivity is not very easy right now in Saudi. What kind of investments does the country need to make in order to ensure it's ready to allow people to shuttle all over the country to get to the games?
Absolutely. It's a great point because it's bringing people into the kingdom, which we know with Riyadh Air coming online very soon, that's going to build that on. But also it's within Saudi itself. So you need, for the host cities, there are 15 stadiums across 5 host cities. And 2 of those host cities are very much out of primary destinations. We do have, obviously, Riyadh on the map and Jeddah on the map with infrastructure. But the connectivity by air, by road, by rail, and by sea is going to be fundamentally important to allow people to very easily and very cost effectively move around the destination, to be able to observe the games, but also to be able to enjoy, again, the Saudi hospitality in terms of being able to understand what the kingdom is all about as a host country. We've seen this transformation before. It's not the first time. I had the blessing of being part of the South African 2010 World Cup, and it was exactly the same. South Africa utilized the World Cup a way as transforming not just its economy, but its society and, importantly, its identity. This is one of the reasons why FIFA hosts in countries that allow genuinely the world to unite and people to fall in love again with the beautiful game, but do it in places around the world that they can fall in love with for the first time, like the kingdom in 2034.
Yeah, absolutely. And you work as an advisor to the Saudi Tourism Authority. Have you seen anything that indicates how much money Saudi Arabia is allocating to the investments that will be needed to make this World Cup happen?
The beauty about this, Christine, is it's all part of, again, Vision 2030. Vision 2030 is about building the infrastructure in Saudi Arabia, not just the hard infrastructure, but the soft. So all of the work that is being done, this is part of the greater sports strategy. So the specific budget behind the World Cup feeds into the greater investment that's being made across the mega projects, across the work that's being done with airport expansion, airport upgrades, putting in rail systems. So it's a collective budget. And importantly, this is all about the greater return on investment. Also, the return on inspiration and identity. So the framework that's being utilized, this has never been about the World Cup alone. This is not about football. This is about utilizing sport as part of Vision 2030 and beyond to frame Saudi Arabia in a way that is genuinely extending an invitation in the world to see how it's changed, even in ways in which it's being challenged.
Absolutely. Well, thanks so much, Anita, for sharing all your insights. We really appreciate you joining. That's Anita Mendiratta, Special Advisor to the Secretary General at United Nations Tourism. Well, let's get a quick check on where markets are faring as we head into the bottom half of this hour. S&P 500 futures and NASDAQ futures both continue to hold their weakness, and actually the Dow as well. So it looks like we're potentially heading for a day of losses on Wall Street. Stocks futures pushing up just a touch ahead of the key ECB rate decision a bit later today. Markets will be looking for what is happening going into 2025. That's it for the first hour of Horizons Middle East and Africa. I'm Christine Burke in Riyadh. Thank you.
This is Horizons Middle East and Africa. Our top stories this morning. Asian stocks advancing after Wall Street snaps a two-day losing streak with US CPI boosting bets of a Fed rate cut next week. Israel carries out more military operations in Syria despite facing intensifying criticism from governments in the region. This as U.S. envoy Antony Blinken returns to the Middle East for a 12th time. Plus, Donald Trump reportedly reaches out to Xi Jinping even as he threatens tariffs, inviting China's leader to his inauguration next month. Good morning. It is just gone 9 a.m. across the Emirates, 7 a.m. here in South Africa. I'm Jennifer Zapasaja in Johannesburg. Welcome to the second hour of Horizons Middle East and Africa. And as we mentioned, U.S. CPI really was the focus for U.S. equities on Wednesday. Although if we take a look at where markets are positioned ahead of the trading day, it's looking a bit muted as far as U.S. equities go. We have the NASDAQ and the S&P up there, but they all closed on Wednesday higher, that despite the Dow snapping a two-day slide after we did get that CPI print many people are suggesting was bang in line with expectations. That sent U.S. equities, the NASDAQ, to another record, closing above 20,000, still above that mark right now. Euro dollar also in focus. We mentioned the ECB is in focus later today, but really the attention is going to be on Christine Lagarde's messaging and the guidance for 2025, although a 25 basis point cut is expected. And finally, Brent crude edging up ever so slightly, but we've seen 3 days of advances. The markets have been digesting a plethora of news as it comes from Syria, that's as well as US CPI. We've also had a report from OPEC about demand expectations. And then Wednesday, we also got some news from the U.S. potentially considering new sanctions against Russia's energy sector. But Brent crude right now just above $73 a barrel. And our terminal chart sticks on this inflation theme. It is proving to be a bit stickier, at least in the U.S., than anticipated. And yet, the print that we got on Wednesday all but cements what we do see from the Fed next week. Probabilities amongst traders now up to 90%. Before we got that print, it was just around 80%. The forward guidance, though, of course, is where we are focused on when we hear from the ECB today, but then also from the Fed next week. Meanwhile, let's pivot to what else we're looking at in the region, and in particular, Israel. They've continued attacks inside Syria despite facing intensifying criticism from governments in the region. The military says it's targeting what it describes as threats and terrorist sites along the border with Syria. U.S. Secretary of State Antony Blinken is on his way back to the Middle East as Biden administration tries to shape the unfolding situation in Syria before Donald Trump's return. Let's bring in Bloomberg's Dan Williams. He is in Jerusalem for us. So, Dan, talk to us about these latest strikes from Israel on Syria and what they're really looking to achieve.
Well, we've seen a really dramatic spree of Israeli military operations in Syria, specifically since the fall of Assad, the longtime leader of that country over the weekend. Hundreds of strikes, which Israel says have destroyed as much as 80% of the strategic weaponry, much of it Russian or Iranian supplied, that Assad has. Israel says this is a precaution to prevent that such weaponry falling into the wrong hands in the aftermath of that revolution. Specifically, it says it does not want Hezbollah, an enemy in Lebanon, with which it is now at a ceasefire after more than a year of fighting, receiving them, or indeed Sunni jihadis who might try to rise up once the situation in Syria is more stable, or indeed if it descends into chaos, and use such weaponry against Israel. Keep in mind, Israel is a neighboring country, and indeed from its border area, Syria is in plain view, including some of this internal fighting. So the Israelis feel the threat very intimately, and they've taken dramatic action to preempt it, to fend it off.
And again, Dan, we're seeing Antony Blinken, as we mentioned, on his way to the region. I believe we said it's the 16th time. I mean, what is he expected to achieve with just a few weeks, really, until this Biden administration leaves office?
I think the Americans see the fall of Assad as something of a foreign policy achievement, though it's not clear to what degree they were actively involved. The United States was actively involved in these stunning events of the last 2 weeks. But I think the top U.S. diplomat, now that the Biden administration is in its last weeks, wants to exercise some sort of control, some sort of influence as to the future, especially the future of governance in Syria. They want to see a Syria that's inclusive, that hews towards what the Americans would see as democratic norms. There is a degree of concern, given the Islamist, perhaps radical Islamist roots of the rebel leadership that has now formed the interim government there. And I think the Americans would very much like to see Syria perhaps on the path of Tunisia rather than on the path of Libya, when those countries experienced similar upheaval in recent years.
And we'll also see Antony Blinken traveling to Jordan and Turkey. We'll look for those comments from him. Bloomberg's Dan Williams in Jerusalem. Dan, thanks as always for joining us. Now, sticking with the U.S., outgoing U.S. Treasury Secretary Janet Yellen says tariffs on China will hurt the U.S. economy and provoke retaliation from Beijing. She spoke exclusively to Bloomberg in Washington.
Broad-based tariffs, almost all economists agree that what they will do is hurt us by raising prices, possibly substantially, and making it more expensive for firms that need inputs from China to be able to acquire them, and harm our competitiveness.
Meanwhile, despite his threat of stiffer tariffs, Trump has reportedly reached out to Xi Jinping, inviting the Chinese leader to his inauguration next month. Let's bring in Bloomberg's Jill Desis, who is in Hong Kong for us. So, Jill, this is quite unprecedented, as our Bloomberg reporting indicates. What do we know about the reasons behind this invitation, especially when you consider a lot of the other messaging that we are getting from Trump and from the U.S.?
Jen, it's quite a head-scratcher here. So what CBS has reported so far is that Trump essentially extended an invite to Xi Jinping to attend the inauguration. Now, a foreign leader, let alone a Chinese foreign leader, has not attended, a presidential inauguration like this, really kind of, as far back as historical records are really showing us here. So, I mean, just even the invitation itself feels very unprecedented, and then the possibility that she would even kind of consider attendance also seems fairly remote at this point. So China's Ministry of Foreign Affairs hasn't commented. I have to say here, Jen, this is would be a really kind of big political risk for Xi Jinping, were he actually to accept something like this. I mean, the idea of going to the United States, Trump obviously has quite a track record of saying a lot of things very off script while he's speaking, and then obviously has developed something of a fairly antagonistic relationship with China, at least over the course of his first term that ended in 2020. So there's a lot of questions around this. Whether or not Xi Jinping actually attending again doesn't really seem likely at this point, but it is very interesting to kind of weigh this against the dynamic that Trump has ultimately developed, as he's, prepared to come back into office here with China. I mean, obviously making, this idea of potentially 60% tariffs on China a central piece of his campaign. So, yeah, it's a really interesting one to watch here.
But it doesn't necessarily tamp down any of the rhetoric that we've seen from both sides, even China, right, Jill?
Yeah, I think that, one thing that you have to kind of figure is how this ultimately plays into the way that Trump is kind of setting up his next term. Yes, in some ways, I think the rhetoric has really remained there. I mean, look at just that, his choice for Secretary of State, Marco Rubio, a massive China hawk in that kind of position, indicating a position that would be very tough on China. But at the same time, Trump has also tapped David Perdue, the former senator, to be his ambassador to China. And I think a choice like Purdue suggests a little bit more moderation in terms of how the U.S. would ultimately be working with China. All that being said, it does seem clear, at least from the China side, that they're prepared to kind of step up and work with the U.S. in any ways possible. Xi Jinping has made the idea that there needs to be some kind of cooperation here. He's kind of made that point before, but he also, when he just met with Joe Biden, outgoing U.S. President Joe Biden last month, kind of signaled that it was a bit of a warning on this need to kind of play nice with each other. So I think at this point, look, the U.S. continues. It's kind of been a bipartisan effort to, sort of push back against China, certainly introduce additional tariffs or, sort of trade regulations, curbs around this development of high-tech technology there when it comes to China. Doesn't really seem like that's going away anytime soon, but I think what will be really interesting to watch in the new year is exactly what kind of push and pull there is to this relationship and how these two sides sort of develop that with each other, because ultimately they're still the world's two biggest economies and they do need each other in very many ways.
Yeah, in very many ways. That's a great point. Bloomberg's Jill Desis in Hong Kong. Jill, always great to get your insights. Let's also check in, though, on the yuan as China's annual economic meeting gets along. Avril Hong is standing by in our Singapore studio with more. Hey, Avril.
Yeah, we're waiting for that readout from the conference, and that could, put more meat on the bones and all these stimulus expectations from Chinese authorities. But the yuan is also in focus because there's been a lot of speculation that China would be more tolerant of a weaker currency next year to boost export competitiveness in the face of higher tariffs. But we're seeing that pushback from the PBOC today in the form of a stronger than estimated fix. And remember, the yuan is allowed to trade around that band, that fix over there. So this is prompting a bit of firming of the Chinese currency. I would also highlight that when you look at currency depreciation for the renminbi, there are risks surrounding this, including capital outflows, knock-on effects on other assets. And that is perhaps some of the reason why Morgan Stanley actually thinks, compared to 2018-2019, when we saw a 12% decline in the Chinese currency, this time around it might not be as severe. And think about how the Chinese currency is also nowhere near the 6 handle of back then. So the idea that Chinese authorities might not have to see that much depreciation going forward on the renminbi to begin with. So keep that in mind as we see the relative weakness in the Chinese yuan. Jen?
Thanks so much, Avril Hong. We'll check back in with you in a bit in Singapore. But coming up, how State Street Global Advisors sees the outlook for 2025. Altaf Kassam, EMEA Head of Investment Strategy and Research, joins us next. Stick with us. This is Bloomberg.
And our budget proposes an additional $3 trillion of deficit reduction over 10 years. And I think that's necessary to make sure that our fiscal path is sustainable. Now, Congress hasn't really done anything to, beyond what I've mentioned, to improve the fiscal outlook, and I think that's a shame.
Treasury Secretary Janet Yellen on the fiscal outlook of the U.S. economy. Investors are betting benign U.S. inflation numbers for November have pretty much sealed the deal for a Fed cut next week. We're also watching out for an ECB rate decision coming later today. Let's bring in Altaf Kassam, EMEA Head of Investment Strategy and Research at State Street Global Advisors. Altaf, great to get you on this morning. So CPI largely bang in line with what many people were expecting. You and your team have largely been of the view that a soft landing is here and is coming. Did this print do anything at all to further cement your view or do anything to your outlook?
Good morning, Jennifer. No, like you say, this print was pretty much in line with what we and the market were expecting. So it kind of, as you say, seals the deal for a December rate cut. And we still are banking on 3 rate cuts for next year from the Fed. So progress is steady as she goes. As ever, every data point will be scrutinized and there will be volatility around that. But we still think the market is on course, or the Fed is on course to achieving a soft landing, even though it might be a bit bumpy into the middle of next year.
We'll talk about that, Altaf, because you're still seeing 3 cuts next year. What is that bumpiness that you're seeing? And could we get some insight from Jerome Powell next week during this meeting?
I think Jerome Powell is going to be pretty cagey next week, and I think he's going to remain cagey until the new president is in his seat and there's a tiny bit more clarity on policy. And the bumpiness comes around that, to be honest. It's the fact that we have a president-elect who's making appointments, who's making effectively policy pronouncements, but isn't actually in the seat yet. And it's hard to work out how much of that is negotiation and how much of that is real. And so that's the bumpiness, really, is that it's the marrying of what the president-elect is saying versus what the president will do when he's in the seat.
And yet we still hear Jerome Powell saying he is data dependent. Altaf, I want to get your insight on U.S. equities and how they are dominating a lot of other equities that we're seeing more globally. Does that continue despite this bumpiness, or could we potentially see some other markets, some other indices elsewhere, taking this as an opportunity? Oh, I believe we lost Altaf Kassam. We were speaking there with Altaf Kassam, Head of Investment Strategy and Research at State Street Global Advisors. We will try to get him back in just a bit. But for now, we'll give you some insights. Coming up, Oh, actually, this is live TV, so I believe that we have Altaf. Altaf, can you hear me?
Yeah, I can. Sorry about that.
It's great. Okay, no worries. So I was just asking, what's your insight into U.S. equities? We're continuing to see new records. Does the dominance continue over equities elsewhere in the world?
Yes, we still think that U.S. equities are in pole position. It's hard to argue against U.S. exceptionalism. I know everyone's a bit sick of that term now. But for us, it continues. The economy continues to power ahead. The equities, even though there's a huge concentration in the market, continue to deliver earnings and return on equity, which even though it's expensive, we still think is worth paying for. We might see that rally in the US broaden out of the large caps and into more small caps and into more cyclical stocks. But for us, it's still the US right now. Clearly, there are always question marks. And if we see some movement downward in the dollar, we may see other sectors outside of the US start to fire. But for us at the moment, it's certainly US all the way.
What about Europe, especially if we consider what we will potentially hear from Christine Lagarde later today? Any interest or opportunities that you're seeing there in 2025?
Yeah, for us, we're generally pessimistic and hence underweight Europe. But we do think an interesting way of playing Europe is through sectors, at least on the equity side. And we think what we're going to see is a diffusion of AI and the interest around AI out of just pure tech into other sectors such as healthcare and industrials via robotics. And those are 2 sectors where Europe actually has great representation. So even though we're generally pessimistic on Europe, we do think that there are select sectors which could work in Europe, and energy as well, given the more relaxed nature, we believe, of the Trump administration towards energy policy. So those might be three sectors which work in Europe, but generally we would still prefer the US overall as a market versus Europe.
And Asia, are there opportunities there? Many people have talked about how they've been, they're cheaper than what we are seeing in the U.S. and elsewhere. Could you potentially look to Asia, especially as we hear more stimulus measures coming from China, potentially some upside?
Yeah, I mean, China really holds the key. And if there's a gray swan for next year, it's that China finally enacts a stimulus which gets its people spending, and that market strongly rebounds, and that will take the rest of Asia with it. A weaker dollar would also help, but again, we don't see that as on the cards in the near term. So the fate of Asia is held in China. With Japan, which was our second pick for last year, we feel like there's a bit too much risk over the monetary policy and over the political instability. So really, it's China that holds the key for the Asian markets.
We'll wait to see how the rest of their economic meeting goes. But appreciate you joining us this morning. Altaf Kassam, EMEA Head of Investment Strategy and Research at State Street Global Advisors, joining us from London. Thanks so much. Now, coming up, European appeal, Bahrain-based Investcorp tells us why the region is still attractive for investors. That's next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Now, for a look at some other stories we are following this morning. The U.S. is warning that Russia may fire another intermediate-range ballistic missile at Ukraine, similar to one it used in an attack last month. This as the Russian Defense Ministry promised to respond to Ukraine hitting a military airfield with what it says were U.S.-supplied missiles. Both sides have recently ratcheted up missile attacks in the nearly three-year war. FBI Director Christopher Wray says he will resign before Donald Trump takes office, prematurely ending his tumultuous tenure as head of the nation's top investigative law enforcement agency. The president-elect had made it clear he wouldn't keep Wray on at the FBI when he does take office on January 20th. Wray told staff that stepping down is the, quote, best way to avoid dragging the Bureau deeper into the fray. And Elon Musk has become the first person to reach $400 billion in net worth. The most recent catalyst was an insider share sale of his privately held SpaceX, which boosted Musk's net worth by roughly $50 billion. Tesla shares also rallied to an all-time high yesterday, pushing its CEO's fortune to $447 billion. And finally, outgoing U.S. Treasury Secretary Janet Yellen said Donald Trump's plans for broad-based tariffs on China will hurt the U.S. economy and provoke retaliation from Beijing. She spoke exclusively to us in Washington.
Many countries, when they're faced with unilateral actions of that sort, look for ways to retaliate. And my guess would be that they would do that. We have in areas of concern where I've expressed repeatedly concerns with overcapacity that is developed in Chinese advanced manufacturing industries and clean energy, semiconductors, and the like. We think it reflects active, large subsidies that are flooding the world with exports and threaten to drive our firms out of business in areas that we think are critical to our own future. We've put in place tariffs. Now, they're strategic. They affected $18 billion worth of trade, certainly not all of our trade with China. And we did it to make sure that China's actions don't undermine our own plans to support these sectors. But broad-based tariffs, almost all economists agree that what they will do is hurt us by raising prices, possibly substantially, and making it more expensive for firms that need inputs from China to be able to acquire them and harm our competitiveness of firms that rely on those imports. So we've taken a strategic approach, focusing narrowly, and a broad-based approach I have serious concerns with, as most economists do.
This is Horizons Middle East and Africa, our top stories this morning. Asian stocks advancing after Wall Street snaps a two-day losing streak with US CPI boosting bets of a Fed rate cut next week. Israel carries out more military operations in Syria despite facing intensifying criticism from governments in the region. This as U.S. envoy Antony Blinken returns to the Middle East for a 12th time. Plus, Donald Trump reportedly reaches out to Xi Jinping even as he threatens tariffs, inviting China's leader to his inauguration next month. It has just gone at 9:30 a.m. across the Emirates, 7:30 a.m. in South Africa. I'm Jennifer Zabasaja in Johannesburg. Thanks for joining us for the second hour of Horizons Middle East and Africa. And let's just take a look at where markets are positioned ahead of the trading day. We mentioned U.S. CPI affecting stocks on Wednesday. Right now, though, looking like potentially a muted open, at least for U.S. equities, ever so slightly muted. But still, as it stands, we are seeing records for U.S. equities. We mentioned on Wednesday they snapped a two-day slide after that CPI print came bang in line. And really that was led by the NASDAQ and by tech driving those gains, seeing the tech notch another record, still holding on to that, although still looking like a bit of downside to start the morning. Euro dollar is also in focus as we turn our attention to the ECB and Christine Lagarde later today. The focus really is on her guidance for 2025 because the expectation is that we will see a 25 basis point cut. And Brent crude is also edging up ever so slightly, up just about 0.2% at just over $73.71 a barrel there. But it is a focus because we've seen about 3 days of advances. The markets have been digesting a number of data points and news items, including what's happening in Syria. There was also the U.S. CPI print and OPEC report. And Wednesday, we got word that potentially the U.S. is considering new sanctions against Russia's energy sector, but Brent crude holding just above $73 a barrel. And our terminal chart sticks on this inflation theme. It is proving to be a bit stickier in the U.S. than anticipated, but still the expectation is that we will see a cut next week. We got probabilities now up to 90% amongst traders. Prior to that, it was about 80%. And the forward guidance from what we hear from Jerome Powell and also, of course, from Christine Lagarde later today is in focus for us. But let's turn our attention to Asia and in particular Asian currencies. Avril Hong is looking at that in our Singapore studio. Avril, how's it going?
Yeah, Jen, it's a mixed bag when it comes to Asia FX. We're seeing dollar China hovering at the 726 level. We've been talking about the yuan weakness a lot, so I thought I'd focus on the Korean won as well as the Japanese yen. In Japan, we have those bets of a BOJ hike for next week just keep receding. We have sources telling Bloomberg that the BOJ policymakers don't really see a need to rush to hike rates. They are okay to wait January or even beyond because they don't see a risk of the inflation picture sort of overshooting. So it's relative weakness on the Japanese yen. Don't forget, tomorrow we have business confidence gauge out of Japan, so that could inform further the picture in the Japanese economy. The Korean won has really been on the back foot, and this is against the backdrop of the president kind of digging in his heels and saying that he'll fight impeachment to the last minute. So this sets the stage for an even longer political crisis in the country. Not great for the economy, not great for the currency. So this is among the FX that we're keeping a close watch on in the region today. Jen?
Thanks so much, Ava Hong in Singapore for us. Let's turn, though, to South Africa. South Africa's inflation rate crept up by less than expected in November amid benign food price growth. CPI rose 2.9% in November from a year earlier, slower than the 3.1% forecast by economists. Retail sales in October, meanwhile, unexpectedly jumped to their highest level in more than 2 years. Let's speak with Gina Schoeman, a South Africa economist and head of CEEMEA Economics at Citi. Gina, great to get you on. So, we did have CPI, again, similar to the U.S., about bang in line with what the expectation was. But dig into the details for us and what Citi thinks is noticeable in some of the prints that we got.
Yeah, well, good morning. Thanks for having me, Jennifer. So certainly you mentioned food inflation being the downside surprise of that 2.9% print. And so even though it's crept up slightly from 2.8 to 2.9, this is still an unbelievably low level for South African inflation, given that we have a 3 to 6% target range and a 4.5% midpoint within that. So yes, food did surprise to the downside. And I think that's hugely comforting, given that we've gone through such an immense goods inflation cycle, much like the rest of the world did over the past 18, 24 months. But also contributing to that very low print was the fact that we're seeing fuel inflation in hugely deflationary territory at the moment. So the coupling of the food and the fuel inflation coming down, being a big drag on CPI is really helping for goods inflation to print now even below that of services inflation. If you had a flip over to the other side of the basket, we call it the other side of the basket because in South Africa's basket, CPI basket, you've got a rough 50-50 split between goods and services. But services inflation is still sticking very low, just around the midpoint of 4.5%. And that's simply because the economy has been relatively very weak up to this point. And so there isn't a huge amount of demand pull in this economy to drive up things such as services inflation. So going forward, we're just expecting some very low prints. And I think that's hugely comforting for South Africans who want to spend, particularly going into the festive season.
Yeah, and we've seen that a bit when it comes to retail sales, Gina. Is the expectation that that will continue? I mean, part of it hinges on what we do see from the SARB and what we see from the economy more broadly. I mean, what's your expectation?
Well, that retail sales print for October, I mean, that was quite immense. I mean, that really surprised hugely to the upside. And it might actually explain why we were disappointed by retail sales in South Africa a month before in September. There were three factors driving that retail sales print in our view. Number one, South Africa introduced what they call the two-part reform on the 1st of September, which effectively allows consumers to withdraw from their pension funds, but in a very conservative way. This is not something that risks financial stability for the country. But those withdrawals in September very well could have urged on consumers to spend through October, together with the fact that that was, of course, the very low that we had 2.8% of inflation in October. And of course, the SARB had already started to cut interest rates in September. So you had interest rate cuts coming down, inflation coming hugely down, and then, of course, your withdrawals from your pension funds, which have also surprised the upside, according to the industry. So those three factors coming together to really push retail sales in October. Whether it continues into November and December we have to wait and see. But of course, with these low inflation prints, another interest rate cut from the SARB that we saw in November, I think it's very likely that we're going to see quite an upbeat festive season when it comes to retail spending and the consumer.
Gina, let's talk about the global picture. There's a number of risks that potentially could affect the South African economy and EMs more broadly. What is Citi's view of maybe the greatest threat to growth in some of these EMs? We talk about fuel prices, we talk about China, we talk about America first. What in your viewpoint?
Well, look, we've actually just published our 2025 outlook, and if you had to split it into the regions, LATAM, Asia, CEEMEA, they're all very different drivers there. Obviously, in Asia, a lot of what the US decides to do creates huge uncertainty. Across CEEMEA, it's a bit of a mixed bag. We've actually got growth improving because we see continuous disinflation across those economies, which in other words means The CEEMEA economy, so Central Eastern Europe, Middle East Africa, obviously there are going to be a lot of outliers, but generally speaking, these countries have won the fight on inflation, but will continue to see disinflation going forward, and therefore can continue to see a move back down to their neutral rates. In other words, more rate cutting. But I think similar for, many LATAM countries and then also CEEMEA, the big risks at the end of the day is we've got an oil price assumption that keeps going lower through 2025. Citi's got, roughly $70 against a barrel. So, 60, sorry, apologies. And so if you don't get as low as that, and obviously with the geopolitics and a Trump presidency, there's huge amounts of uncertainty around that through 2025. So whatever happens to the oil price is a big determinant of it. We also don't see food as a massive shock to any emerging market through 2025. And that's something we obviously need to watch. It was one of the biggest downside drivers to South Africa's inflation more recently. But if anything starts to become uneasy in food, the problem there is that goods inflation, particularly in not just EM baskets, but in the CEEMEA region, it's a huge weight of your CPI basket. So, we have to keep our eye on the China-US relation because that's going to create FX volatility, commodity price volatility, potentially, and then, of course, that spills over into what we think about oil prices and food prices.
Right. Gina, always great to get your insights. That's Gina Schoeman, South Africa economist and head of CEEMEA Economics at Citi. Thanks so much for joining us this morning. Let's pivot back to the Middle East. The swift collapse of Bashar al Assad's regime in Syria is threatening a key Russian airbase that Moscow depends on to project influence throughout Africa. Russia uses the base to send personnel and military supplies to Mali, Burkina Faso, and Niger, all of which have experienced recent coups and cut ties with the West while moving closer to Moscow. For more on this, let's bring in Tony Halpin, Bloomberg's team lead for Russian economy and government. He's joining us now. So, Tony, how significant is this airbase for Russia's influence in Africa? Talk to us about what you and the team dug into for this story.
Yes, well, it's pretty central to Russian efforts to project power and influence in Africa. Africa has been an area where Russia has been seeking to expand its presence in competition with countries like China and the US. And what the base at Khmeimim does is allow them to transport personnel, military equipment to places, as you say, like Mali, Burkina Faso, Niger, and as far south as places like Central African Republic, so that it can, in fact, have a presence on the ground, provide assistance, in particular military and security support for rulers in those countries. And the ability to do that is critically dependent on the airbase in Syria. Without that airbase, it's very difficult for Russia to maintain those contacts, to maintain those transport links, and therefore its influence.
But do they have other options potentially to maintain that influence? And this could potentially affect even some of these countries that we were talking about there. What are the alternatives for Russia?
Yes, I mean, it does have some air bases in Libya, but the problem there is that it's very difficult to use those bases to reach out to some of the places in Africa where Russia has built ties, not least because of difficulties in reaching Libya through European airspace because of the war in Ukraine, where Europe has closed airspace to Russian aircraft. So there are not really any alternatives for Russia that do the same kind of job as the base in Khmeimim. And of course, they also have the seaport in Tartus, which is Russia's only Mediterranean seaport. That's another area where they're able to project influence thanks to their presence in Syria. Both of those things are now in doubt, and Russia's working very hard to try to maintain its presence there, in some ways by reaching out to whoever emerges as the new leadership in Syria.
Tony Halpin leading our Russian economy and government coverage there. Tony, thanks so much for joining us. Now, for a look at some other stories we're following. Ethiopia and Somalia have agreed to lower tensions following talks brokered by Turkish President Recep Tayyip Erdogan. The deal allows Addis Ababa to build a military base on the coast of the breakaway region of Somaliland in exchange for a stake in Ethiopia's national airline. Ghana's economic growth accelerated in the third quarter to the fastest in almost 5 years after solid gains in the industrial sector. GDP grew 7.2% from a year earlier, the quickest pace of annual expansion since before the pandemic, and well ahead of estimates. And now coming up, a fourth rate cut for the year is on the cards as the ECB meets for the final time in 2024. We are live in Frankfurt with a preview next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Now, the European Central Bank is holding its final policy meeting of the year today and is widely expected to deliver its fourth rate cut of 2024. Traders will also be looking for clues on the path ahead. Lizzie Burden joins us now from Frankfurt, excuse me for that, with a preview. Lizzie, is a jumbo rate cut off the table today?
Well, Jen, investors can't seem to shake the idea that a jumbo cut's coming at least one of the next three meetings. Because just think about everything that's happened since we last spoke for the ECB meeting in Slovenia. You've had at home Germany and the France governments collapsing, and then that brings the risk that they won't have the fiscal tightening for the ECB to help rely on to get inflation down. But abroad as well, Donald Trump, of course, has been re-elected to the White House, and the euro area very much in the firing line for his tariffs. So you could argue that a jumbo cut would help preempt those risks. But really, if you look at it, it's only 7 weeks until the next ECB meeting. So why not wait until then? And Donald Trump will be in the White House by that point. The Doves even aren't calling for this loudly. In our survey, only JP Morgan sees it happening today. And the Hawks are not going to be voting for a jumbo cut, given that rise in negotiated wages in the third quarter. So yes, the Latvian Central Bank Governor Martins Kazak says it's on the table, but it's not looking likely today.
And when we talk about the path ahead, Lizzie, what's your expectations in terms of the signaling that we could get from Christine Lagarde?
Well, it's going to be really interesting because we'll get the updated forecasts today, but they've got to factor in all of those risks that I just set out that will affect the euro area economy in the time horizon which goes into 2027. So it's hard to say how much clarity these forecasts are actually going to provide. Since the last meeting, it does seem that the growth and inflation risks have darkened somewhat. And you'll remember at the last meeting, Christine Lagarde was saying that the inflation risks were tilted to the downside. Maybe we get that actually in the statement this time, but I would expect in her remarks, again, we'll have a reference to data dependency. She'll say it's a meeting by meeting approach, but this time perhaps we'll get a bit more of a dovish tilt.
Yeah, many people waiting for that. Bloomberg's Lizzie Burden bearing the cold out there for us. Lizzie, thanks for joining us this morning. Now, coming up, Saudi Arabia shoots and scores, actually. The kingdom officially announced as the host for the 2034 FIFA World Cup. We're live in Riyadh to discuss the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Saudi Arabia will host the 2034 World Cup, marking the return of the world's biggest sporting spectacle to the Gulf region for the second time in 15 years. The decision is being seen as a major victory for Crown Prince Mohammed bin Salman's push to improve the country's image and attract tourists. For more, let's go to Bloomberg Saudi Bureau Chief Christine Burke, who is standing by in Riyadh. So, Christine, take us through what we do know about the kingdom's plans and what this could look like.
Well, in typical Saudi Arabia fashion, the kingdom's plans for this World Cup are big. So the country has said that it's going to have 15 different stadiums across 5 different cities to host these games. And those cities not only include here in the capital of Riyadh, but in the coastal city of Jeddah, and even in some far off locations like Neom, for example, Abha, which is a place I'm sure not many of our viewers have even heard of. Now, we don't know how much investment the kingdom is planning to earmark for such a massive plan. But it is information that we are looking out for. And I'm sure it's going to be pretty big, because not only does the kingdom plan to build 11 of these stadiums from scratch, but also the kingdom is going to need to work pretty hard to improve connectivity throughout the country in order to allow these fans to get around. And I can tell you firsthand that there's not great connectivity here at the moment. So that'll be one thing that we're working to report on in the months to come, is what kind of price tag we're looking at for Saudi Arabia to host this thing. I think the other crucial question that people are asking at this moment in time is, when is the World Cup actually going to happen? Saudi Arabia's sports minister said yesterday that the decision on the timing of the 2034 World Cup hasn't yet been decided, and that's ultimately going to come from FIFA. But I think we're all but certain to see that we're going to have another Winter World Cup, which is what we saw in Qatar in 2022. And of course, we got that Winter World Cup because of the climate here in the Middle East.
I would hope it's in winter. I can't imagine playing it in summer. But Christine, you mentioned the 2022 World Cup. There was a bit of controversy around that for Qatar. There's already been a bit of controversy around this decision. Excuse me. Can you walk us through that?
Yeah, look, I don't think anyone out there, isn't under the impression that this is not a controversial decision. It clearly is. And we had seen in the run up to this a lot of noise out there, if you will, around the potential for Saudi Arabia to host. Human rights advocacy groups have argued that Saudi Arabia will almost certainly need to rely on forced labor and will exploit migrant workers in order to get all of this World Cup construction done. In the run up to the decision by FIFA, we also saw 2 U.S. senators that came out and asked FIFA to reject Saudi Arabia's bid on the grounds that it has a poor human rights record. Now, as you mentioned, this is not dissimilar to what we experienced in the run-up to the Qatar World Cup. That country also faced a lot of criticism. And we know, actually, based on comments from Qatar specifically, that there were 400 to 500 at least migrant deaths due to construction for the World Cup. There was also some criticism for Qatar around LGBTQ rights. There was also a ban on alcohol in stadiums. So definitely those are some of the things that we can continue to be a part of the narrative around this World Cup in Saudi. But I think at the end of the day, what Saudi Arabia is hoping is that by hosting a World Cup, it will be able to further its Vision 2030 agenda to diversify the economy away from oil and to bring in more tourists. Tourism is such a huge part of what Saudi Arabia is trying to do. It wants to become a top tourist destination. And if we look to Qatar, Qatar actually saw its tourism arrivals increase 58% in the year after the World Cup. So even though that was also shrouded in controversy, it still put Qatar on the map at least a little bit more than it had been before.
Thanks so much to Christine Burke, our Saudi Arabia bureau chief there in Riyadh, for us with the latest on the World Cup in 2034. Great to get you on, Christine. Let's take a quick check at where markets are positioned ahead of the trading day. Looking like a bit of a muted open, at least for U.S. equities. But again, Wednesday, we did see them notch new records after that CPI print. The Euro Stock 50 futures not doing too much, a little bit unchanged as it stands, but we are waiting to see what does come out from the ECB later today. And of course, we're looking closely at Brent crude, a little bit unchanged today. Let's take a look at where it is up. Actually, Brent crude up just about 0.3%. So significant moves there. But this is where we leave it for Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Stick with us for Daybreak Europe.